Hi guys, you're welcome to our channel. And on this channel, we make the study of accounting, economics, and IT easier for our students. And this is your regular accountant and accounts teacher, Sir Moscow. Now today we want to look at accounting, and we are beginning with something that is very important in accounting and even in the life of an accountant, because you know that the basic role of an accountant is to prepare an account, right? The final accounts. So we are going to look at a small portion of the final accounts of a sole trader. So a sole trader, someone who manages his own business, it's not a company, but what a sole trader. How do we determine or prepare the trading accounts of such entity? Now, in preparing the trading accounts, as you know, in accounting, everything is formats, right? You have been told what to do. And in these formats, it is your responsibility as a student to understand the formats, but not merely keeping the format in memory, because learning becomes more difficult when you are keeping information in memory. I mean, information that you don't understand. And that is the purpose of this video, is to help you understand the, the, the format for trading accounts so that whichever information you have at your disposal, you can then put them into the formats for you to be able to determine whatever that you want to determine. So before looking at the formats, let's look at the purpose of the trading accounts that you want to look at today. The trading account is prepared to ascertain or to determine gross profits or loss. So when you pick the complete account, which is the trading profit or loss account, you can have gross profits, you can have net profits, but the trading account is prepared basically to determine the gross profits. So the gross profit we are mentioning here is the excess of sales revenue over the cost of sales. So the sales revenue is the total amount that you realize from the sale. So let's say the year or the month that you are preparing the account for, how much did you gain from the sale? That is your sales revenue. And how much did you incur in selling the item that you have sold? And so the cost that you incurred in selling is the cost of sales, and then the revenue or the amount of money that you gain from the selling is your sales revenue. So when you strike the difference between the sales revenue and then the cost of sales, then the difference becomes a gross profit. It becomes a gross profit when the cost of sales is less than the sales revenue. So that is why we are seeing the excess of sales revenue. So the sales revenue is more than the cost of sales. That excess becomes the gross profit. But if the otherwise happens, where the cost of sales is more than the sales revenue, then you get the gross loss. Okay, if the otherwise happen, you have gross loss. So now let's look at the format itself, the format for trading accounts. Now, these items you see here, the GHS you see here, is my currency symbol. We are making this video right from Ghana. I'm a Ghanaian. And so this is my currency. We call the currency Ghana cedis. So this is a symbol. So if you are based in the UK, you will use your pounds. If you're based in the US, you use your dollar. Where if you are, let's say, in Cote d'Ivoire, you use your CFA. So your country's currency will be what you presented, or the currency for the company or the institution that you are preparing the account for will be the one to be presented. Thank you. So let's begin. Now, even if you tell an ordinary man on the streets to determine profits, okay, what the person will do is that the person will just pick the amount of money he gained from selling something and then also subtract the cost he also incurred in selling the item. That's what even the ordinary man on the street would do. So we determine the gross profits, which we can determine by preparing the trading accounts. We begin with the sales. The sales here is not sales in quantity, but sales in value. The sales here is the total amount of money that you gain from selling the commodity that you are considering. So let's take for instance, you are preparing the account for a whole year or for a month. How much did you sell for that year or that month? That becomes your sales. So here we are going to use hypothetical figures. We don't have any questions, so we are just using any figures to understand the format. So let's assume we made a sales of 100,000 for that particular month or year. So this is our sales revenue. Now, the next question we have to ask ourselves is that, did any of the customer return the item that they bought to the company? If none of the customers return the item that they bought, then we can confidently say that we have the whole 100,000 as our sales revenue. But in an instance where some of the customers return some of the item that they bought, then we don't have access to the whole 100,000, because customers can return some of the items that they do purchase from companies or from businesses, probably due to faults or the item not meeting their specification. So in that instance, you can't claim the whole revenue that you have written. You now have to adjust that revenue to suit the situation on ground. Now in accounting, if customers buy from you and then they bring those items back to you, we call that return invoice. Return invoice because in accounting, when you are preparing any account or doing anything, you represent yourself to be the company. So we are preparing the account for a particular entity or particular business, and we are naming it return invoice because the items were sold out and they have brought it back into the company. So what have they done? They have returned the items into the company, right? So we are saying return invoice. The items were returned into the company. So we call that one return invoice. So when that return invoice comes, we cannot so say we have 100,000 in sales revenue. No, because out of that 100,000, is going to reduce by the total amount of returns that the customers have made. So now let's assume the customers return 5,000 worth of the commodity. So if they return 5,000, it will mean that we don't have 100,000 anymore. What you're going to have be the 100,000 that we sold minus the 5,000 that they returned, giving us a balance of 95,000, and that is called net sales. So that is the actual sales that we made for the period under consideration. So now that we have net sales, we can go ahead to look at the cost components of the whole account. We are beginning with opening stock. Now, when you say opening stock, another name for stock is what? Inventory. So it means that, let's say we are preparing the account for the year 2024. Before we began the year, or when the year 2024 began, it may happen that in the previous year, there were some items we couldn't sell in the previous year, and we have brought them into the new year. So if there are items that we couldn't sell in the previous year, but we have brought them into the new year under consideration, or the year that you are preparing the account for, that item becomes what? Opening stock. Because now we are going to look at the cost of the whole item that we have sold to our customers. And so even though we may buy something to sell, but we also began the year with something. And so that item must come. So let's give it any figure. Let's say 10,000. That is our opening stock, 10,000. So we began the year with 10,000 worth of goods. Now we have purchase. So aside this 10,000 that we began the year with, we also made some purchases within the year, right? We made some purchases. So those purchases that we made within the year must be added to the amount of goods that were available at the beginning of the year, so that you will be able to know the total goods that we had for the whole year. So the purchases must be adjusted because there are other costs that you must factor in the determining of the entire purchases. So